9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
We are counting down to the open of markets in Greater China. Let's get to your top stories today. Asian stocks extending a volatile week as oil climbs yet again. As you can see, we're close to 100 again on Brent. You have this escalating Middle East war outweighing a plan by some nations to release crude reserves.
Strains in the private credit market also hurting investor sentiment. A wave of redemptions forcing firms like Morgan Stanley to cap withdrawals from their multi-billion-dollar funds.
Also ahead, Chinese tech stocks in focus as Beijing tightens curbs on an increasingly popular OpenClaw AI agent.
And Guotai Junan says one employee was detained after Hong Kong authorities raided its office and that of fellow broker Citic Securities. I think the headlines say for itself. It could be a bit of an ugly morning here today when it comes to Asian markets. You add kind of the concerns around $100 oil once again. Here we go again. Despite what we're hearing from the IEA, from the U.S. about releasing strategic reserves, it's not really doing much for the oil price here right now. And then you add, the OpenClaw warnings. You add about private credit. You add about this raid of brokerages in Hong Kong. It just spells like bad news today. Yeah,
there's really not a lot, if any, good news today that we can sink our teeth into, at least on a sort of macro level. And it's, you tie everything together and you get a market where 100 on Brent, 160 on dollar yen. You have the credit space acting up, right? So whether it's private credit, spreads are widening when you look at IG and high yield, obviously from a very, very tight starting point as well. And, you extrapolate that, and are growth forecasts currently too optimistic? Are we poised to see some earnings downgrades as it pertains to equity markets? And, how far is a recession still a massive tail risk at this point in time, especially if oil remains at 100 for a prolonged period of time?
I think it's interesting. The BI folks there at Ziyad in the Middle East,
they've modeled this out.
They started changing the model. Ziyad Dodd, when they talk about, it's not about intensity anymore. It is still about duration of how long that Strait of Hormuz is going to shut down. And they've been changing their model, saying 1 month of closure. Brent could hit 105, but they're talking if we do hit 3 months of basically effectively closure there, we're talking 164 levels for Brent here, which sounds just insane at this point. But as we continue to see these mixed messages from the U.S. side of things of how this is going to end, I think, volatility is here to stay, and we're going to be talking about this for some time, unless there is something in the works here to put things to an end. Yeah,
and how quickly does it come to an end, right? Because there's a duration mismatch between, say, these massive reserves being released into the market and when people actually feel that and get that supply.
And when oil infrastructure is actually repaired, right? Which could take months as well.
But yes, that's just to say markets are on a fairly weak footing right now when you look at the risk appetite and the premium that's been built into the markets on the back of everything Yvonne and I just mentioned here. So yes, we are closing in again on $100 on Brent crude. We were closer about an hour back when things opened on Brent. 160 is on the cards, ? We are closer certainly to that level. We have some key technical levels, though, to get over as we approach 160 on dollar yen. It is that familiar dance, though, across these markets where oil is up, yields are up on the back of inflation expectations. Bonds are obviously not doing well. There we go on your screens. 11 basis points in the Aussie 10-year yield. We're getting Singapore also coming online. I'm looking at my screen. Singapore 2 years up 7 basis points. The dollar is again doing that dance to the upside. And when it does that, this is what happens to equity markets. We're on offer. And the silver lining, though, just to note, is that we're really not seeing the extent of the losses on Monday, right? So it's mostly still an oil and an FX story and a rate story, not so much an equity market story. Going into the open today, Shanghai oil coming up on your screens, A50 futures and dollar China, given this resurgent dollar that we're seeing going into this Thursday open 25 minutes away.
Yeah, and I think it goes back. There was a great interview that I think Surveillance did with Jeff Curry from Carlyle about there's no amount of policy out there that is going to be enough to stop the ascent of oil prices, because it's not just the headline numbers of how many millions of barrels that they're going to be able to release. It's about flow rates and how quickly they can actually do that. And this is probably why you're seeing oil traders really ignore some of the signals that we're hearing from the IEA, from President Trump on those measures to stabilize prices. Let's take a listen.
IEA countries have unanimously decided to launch the largest ever release of emergency oil stocks in our agency's history. IEA countries will be making 400 million barrels of oil available. I repeat, 400 million barrels of oil available to the market to offset the supply lost through the effective closure of the strait.
The market's holding up well. I figured we'd be hit a little bit, but we were hit probably less than I thought, and we'll be back on track in a pretty short while. Prices are coming down very substantially. Oil will be coming down. That's just a matter of war. That happens you can almost predict it.
Yeah, we're still waiting for oil to really come down, as the president was putting it there. The U.S. also releasing 172 million barrels from its strategic petroleum reserves. To put everything together for us out of Singapore, as you can see on your screens now, our oil trading reporter, Wrong Way, Neil, is here with us right now. So obviously, oil prices are again melting up. Talk to us about the latest developments that are effectively creating these conditions right now.
Well, of course, all eyes are on the release of strategic reserves that was just approved by the IEA, as we've heard earlier. And as President Trump has said, he hopes that oil prices will go down. But unfortunately, at today's open, things didn't quite swing that way. Now, to break down the numbers, although the US has said that they will release about 170 million barrels of oil from their reserves. As Yvonne has mentioned earlier, all these will actually take time to flow into the market. There is kind of like a lead time for them to do so. They have to complete sales, and then there's the logistics as well. And also, to put things into perspective, right now, US's strategic petroleum reserves currently stands about over 400 million barrels. It's about 60% filled, but you can imagine that the amount that they plan to release is nearly half of what they already have. So I believe that a lot of people in the market watchers, are looking at this. They're not just digesting the headline number, but they're also taking a wider perspective on what this release actually means. And being strategic reserves, they ultimately have to be filled at a later date. So all that would also weigh on the traders' minds as well.
Yeah, and there was also a headline that came through about Iraq also halting their ports, completely stopping operations there. I mean, it seems like the supply situation is actually getting worse in the Middle East.
All right, so of course, if we talk about middle-term to long-term measures, there is the release of strategic petroleum reserves that could help alleviate supply risks in the oil market. But let's not forget that there is a war that's actively raging on, and we can already see the impact. So Iraq has said that its oil terminals would stop operations. That's because 2 tankers will hit offshore. And that really, I would say it's a rude awakening for traders to remind them that despite all these policies and measures that are being put in place, what's really immediate right now are the current supply risks. So 2 oil tankers, that kind of stokes fear in the market that basically all these tankers around in the Middle East, actively carrying billions of dollars worth of oil, could actually be hit. And with some of these ships not being properly insured, that could lead to devastating financial losses for a lot of people along this trade supply chain as well. So we believe that that's one of the key drivers that is really pushing up oil prices at this current point in time.
We were speaking around this time yesterday on what's going on or what isn't going on in the Strait of Hormuz. Do we have any more clarity currently on the situation there?
So unfortunately, things haven't quite, I would say there wasn't any substantial development over the course of the day. We are hearing things actually, it's similar to a stream of information we've been getting over the past few days. Talks about ships, not just oil tankers, but bulk carriers, container ships that were looking to transit through the Strait of Hormuz as well. It's unclear whether if any or most of them have actually made it across. There's also talks about attacks and some turning back. It's a very hectic situation. We can call it like the cloud of war that is currently hovering over the area. Information, it's not coming out as coherently as we would like. And a lot of our work right now is actually it's actually focused on verifying a lot of these market chatters. I would say user-generated content, UGCs, and videos we are seeing off social media on feeds like X, and chatting with the people involved in the trade on how all these images that we are seeing online are actually translating into actual impact in the oil trade.
Yep. Needless to say, I know your team has been busy. Rongwei, we'll leave you get back to your desk to really track all these things that are going on. Rongwei Neo there, our oil trading reporter, joining us from Singapore. Now, after, of course, Tencent, Minimax, and Zhipu, now Baidu has released its own version of OpenClaw. Now, it's called DoClaw. It's a service that allows users to assess and access the OpenClaw agent through its Baidu AI cloud. Let's bring in Belle, our Asia Tech correspondent, joining us now. So we'll talk a bit more about the regulatory scrutiny later, but tell us about what Baidu is offering now.
Yeah, well, essentially, as you said, we've sort of seen its peers doing it, and now it's come out overnight in the last 12 hours or so. But essentially, yeah, it's a service that lets users gain access to the OpenClaw agent. They're saying that the point of difference on this one is that it's easy for non-technical users because it's got what's called zero deployment. So the others require some level of setup or environmental configuration, but this one's allegedly a lot easier to use, or that's what Baidu is saying. The price point on this as well, I mean, it's around $2.50 a month, so relatively cheap to access. But I think it's interesting that even though you saw this being released, as I said, about 12 hours ago, you didn't see that same lift in ADRs, which I think does point to, yes, you've got that broader scrutiny, but maybe some of the heat coming out of this trading activity as well around these stocks.
Well, speaking of heat, enough attention over the last 24 hours to garner regulatory scrutiny.
Yeah, that's right. So we had a Bloomberg scoop on this and just talking about what the government is doing now, and essentially what we understand from our sources is that they're moving to restrict the use of OpenClaw at SOEs and also government agencies, and that includes the largest banks and the companies. So they don't want staff or people to be using OpenClaw AI apps on office computers. So we understand that comes down to security reasons. I don't really think that's any sort of surprise. Some of the cybersecurity experts we've spoken to have said that you've essentially got a lethal trifecta here because you're giving the technology access to a lot of private data. It's got the ability to communicate externally. It's exposed to untrusted content. There's plenty of case studies online where you can read people's reviews and OpenClaw has essentially gone rogue or has been tricked by malicious software. So this move from China, of course, attracts greater scrutiny or concern because we see generally that they don't like to see control around this, and you've seen, of course, the various crackdowns and that great internet firewall as well. But the reaction from our Bloomberg intelligence team and Robert Lee in particular has been that this isn't necessarily something that restricts the private sector essentially, and you may still see people continuing to engage and interact with OpenClaw through the various services that are now offering them, like Baidu, but Tencent, Minimax, and Zhipu.
Yeah, so we might still see those lobsters out there. Can't get enough of them.
Don't give up the hats just yet.
Yeah, so it won't derail, as Robert Lee said, the wider adoption of this technology, but certainly one thing to look at in terms of the flags that are being raised around the security side of things. Belle, thank you. Our Annabelle Jewelers there. Make sure to check out that explainer, too. Saritha Rai wrote a really good piece about this.
Really good question.
About, is OpenClaw really that AI marvel that we've been talking about, or is it a cybersecurity nightmare? There's a good explainer out there. Make sure to check it out this morning.
Yep, there we go. Yeah. Coming through as well here, it's been quite the start to the year. Here's a statistic for you. Okay, I'm having trouble getting down. We are set for the third biggest quarter in terms of the jump in oil prices in the last 40 years. How does that affect the equity markets outlook? SocGen will be joining us in a couple of minutes to lay out their scenarios for us. Counting down to the open markets in Greater China, 15 minutes away, Shanghai, Shenzhen, and here in Hong Kong. This is The China Show. Good morning.
All right, here's your agenda today. As we've been talking about, it is that OpenClaw frenzy. Of course, Baidu coming out with its own sort of offering. That could be an interesting one to watch here today amidst this regulatory scrutiny, which we've been talking about from China. It is the last day of the MPC, so that closing session is underway. We're still waiting for some credit data out of China. Earnings to tell you about. Certainly, there'll be some ones in focus here, given what we have seen and when it likes to this week. Who's reporting? Do you know, Dave?
Well, we had the whole. So we had. That's a good question.
I lost my train of thought, and then
I mean, no one blames anybody now for not paying attention to earnings.
Right?
Given
how important are they?
We have the Swire Group coming out today.
There you go.
Yeah, there we go. So it's Swire Pacific. Obviously, just talking about Cathay Pacific was yesterday.
Capricorn. Sorry, I also remember that. Li Auto.
Oh, yeah. Okay. So chips, generally speaking. On separate stories, right, you might have seen, of course, the probe on that's taking place here in Hong Kong. We'll get to that in a couple of minutes here. It pertains, of course, to two Chinese brokers. We'll get into the story a bit later on. We're also looking at Baidu. Of course, we were just talking with Bell early on, and as well as the shipping angle to this as well. Okay, now, in terms of just sectors to watch, everything from precious metals, cyclicals, energy remains very much in focus. Massive move higher in the U.S. session yesterday on energy counters. The rest of markets are not doing as well going into this Thursday.
Yeah, here to give us a bit more, what to do next. Let's bring in
that's a good way
Frank
to put it.
Benzimra, Head of Asia Equity Strategy at Societe Generale. Frank, it's always great to have you. It's not normal to be seeing moves like this, wild swings in oil markets. You're seeing equity markets, seeing 5-6% moves in some of these regional benchmarks here in Asia. What do I do in the midst of all this sort of headline risk now?
I think the best thing to do is to look at the investment opportunities and to look at two things. One is that the U.S. market has been super resilient, and you see the trend in earnings has remained untouched. The second thing is that we see the stronger dollar, but we still remain in a peak dollar environment. And if we believe in this, the EM asset story in general, and especially the emerging Asia equity, the story is not over, and we are going to see some investment opportunities.
Tell us why we should not worry about this oil price spike and what that means for growth in earnings.
Okay. Well, I would not say that we should not worry, but I think that it's important to look through. And the title that I gave to my to my outlook yesterday was "It's a year of anarchy, but that's not the end of the bull market." And the reason for that is that you have anarchy, you have this end of the liberal order, but it doesn't mean that you have chaos. You have some spike in volatility in some market, and we've seen this very much on the Korean market. But it's still something where you continue to have earnings, you continue to see, but the positioning is pretty low actually, and you look at what has declined in Asia, it's been mostly what has increased the most since the beginning of the year. Yeah. So it is telling you something more about the positioning of the market than really the fundamentals.
It is positioning, at the end of the day. That's why you are neutral when it comes to the Taiwan markets, Korea here right now. Have we seen the best of that market now, you think?
I think so, especially in the case of the Korean market. It's what we've called the 3C on Korea, the concentration, which is unprecedented in a very, very small number of stocks. The cyclicality of the market. You look at the long-term chart of earnings in Korea, we are still in a cycle. So there has not been any structural trend of the growth. And number three, it's a currency. And we have seen this very unusual decorrelation between the currency and the stock market. It should reconvert at some time. So we are not negative on Korea, but we think that being overweight at this stage is maybe the risk reward is maybe not enough.
And just on the Taiwan note?
Yeah, Taiwan is a little bit more stable, given the weight of TSMC in the index.
Right.
So you have a little bit less cyclicality on that market.
And maybe that's why you are looking at overweight when it comes to China. We'll talk about India in a bit, but China itself has been quite resilient, right? You take a look at the beta in this market, the correlations, it really is a little bit more insulated.
It's like a time deposit, actually.
Yeah. Is that diversification play? I mean, how do you still play it now in China?
Yeah. So it's a diversifier. We've seen this in the bond market since the beginning of the decade, as only Chinese government bond did well. In the context of equity today, it's not only the low beta to the global market, but it is also what you see in the technology sector, especially this localization of the supply chain, and you have a different ecosystem than what you have in the US. And Korea, Taiwan have been very much in the US ecosystem, and so they have benefited a lot. But we need to look as well as a diversifier of what we see in China, especially in the hardware technology, but also in the old economy sector.
Frank, we'll have more from you. Please stick around. Frank Benzimra, their head of Asia Equity Strategy at SocGen. We'll have final thoughts, of course, in a couple more minutes. Just very briefly, before we head to the break here, 7 minutes to the opening bell, and we are called lower across these markets, which is fairly consistent with the move we're seeing across the region. Down, but not down by a lot at the moment. Plenty more ahead. This is Bloomberg.
Some stocks to watch here when it comes to the brokerages. Obviously, given our source and our scoop about Hong Kong authorities raiding the offices of brokerages like Citi Securities and Guotai Junan, you are seeing Guotai Junan shares down some 4% here this morning. What this means, I mean, there are implications potentially of what this means with the IPO market, which has been quite hot. That's why potentially we are seeing a Hong Kong exchange lower here this morning. And Baidu as well, joining in the fray after we heard from Minimax and Alibaba and the like, talking about their sort of adoption of OpenClaw. We're not quite seeing that positive sort of tailwinds from that story here this morning. And yeah, we're watching, of course, the pre-market in Hong Kong today, Dave.
Yes, and we are slightly to the downside, about 3 minutes to the opening bell here. That's 0.7%. The usual, in terms of what is moving underneath the hood here, so you have, as expected, the oil counter, CNOOC, PetroChina, are up about 1.5% to 2% in the early goings. The opposite is true when you look at HSBC, Alibaba, AIA, and China Construction Bank leading the early decliners there. The opening bell is coming up next. This is Bloomberg. Right, welcome back. Market story is declines across equity markets. Not a ton, not a whole lot. Orderly declines in the equity markets. It's really oil and FX we're tracking very closely, and bonds. Right, so oil is near 100 again, 98, 99 on Brent. Dollar yen is at about close to 160, 158, 159. And bonds are just acting up the way you would expect given the spike in oil prices.
Yeah, we were talking about what Ziad Dawad from Bloomberg Economics was saying, right? If this Strait of Hormuz closure goes into a third month, they're talking about $160 oil or north of that. You're starting to get more analysts from the sell side. CBA is also saying that Brent might hit 150 if this Iran crisis lasts months. So that continues to be the headline risk that is weighing on these risk assets here today. As we talked about, you're seeing that insulation at least and that resilience in these Chinese markets. We're pretty flat when it comes to CSI 300. And we're seeing when it comes to Shanghai crude, there you go, being kind of following the price of Brent and WTI. We are seeing those futures in Shanghai surge once again, another 12 to 13%. And then you take a look at some of these large cap names like CATL, that continues to be a really bright story after this earnings came out. Capricorn Tech is the next one to come through here. We're flat when it comes to stock here right now, but certainly the chip space will be in focus here today. Those stocks, though, that stock has been down some 15% year to date, though, of late. Let's take a look when it comes to the rest of the Hong Kong markets there. And you are seeing more moderately lower, but, you know, it is better than the rest of the region, you could say. HS Tech is on offer here today. So once again, you're seeing maybe a bit of that, I guess, guess, chill, given some of what the regulatory sort of comments that we got when it came to the use of OpenClaw, right? Our source is saying, according to our scoop, that they are trying to curb the use of OpenClaw and at least of banks and state agencies. Does that change the whole wider adoption of OpenClaw in China? Our Robert Lee says not quite. You're still going to see the private sector engage in this in a big way. Baidu certainly is the next one to join in on the fray. But then again, we're seeing at least risk off across the tech space here, given some of these Iran headlines. You are seeing the likes of Meituan down more than 1%. Marginal moves, though, but you are seeing when it comes to the property space, HSBC also down some 2% here this morning. The currency is slightly on the weaker side. But of course, it is, that dollar strength coming through here, given these risk-off moves that we're seeing around the Iran situation. Oil is approaching, of course, 100 once again. So this is what we're watching out for with some of the oil giants in China. Mixed picture here so far in terms of the shipping space as well, the energy space. But you are seeing PetroChina at least up about 1% this morning. Autos has been in focus. Obviously, we have Li Auto earnings coming through later on today. But there is, of course, that sales drop that we saw when it came to car sales, 15%. So, of course, as we talk about these subsidies ending, that has deepened, in fact, that holiday slump when it comes to car sales. Mixed picture across some of these EV makers here today. And, of course, we're watching the brokerages, right? The scoop that we had about Guotai Junan, Citic Securities, their offices rated here by Hong Kong authorities. You are seeing Guotai Junan shares down some 5%.
Yeah, just a brief look at across equity markets, an update if you're curious where we are. So you have Taiwan coming online this hour. There we go. We're down about 0.5% to about 1% between the major benchmarks. Bond markets, there are 10s coming up on your screens. Oz is up double digits. We're looking at India futures as well. 24,000, we've taken that out on the Nifty, and we are set for a 5-6% drop so far this month, which is something that is quite rare in that market. Still with us here for some final thoughts is Frank Benzimra, head of Asia Equity Strategy at SocGen. I'll ask you about India, maybe Japan if we have time in a moment. But just to close your thoughts on why Chinese markets have been resilient, how much of that is down to just who owns things in the market? Is that down to just foreign and local ownership?
Well, it's not only a low foreign ownership, but this foreign ownership has recently decreased. And you look at the fund which went into the global emerging market, it went up very sharply. The one which went to China, they decreased. So you have this low foreign ownership, and I think this is explaining a lot. And then you have some more specific element, and the fact that the currency has been very stable, has been kind of on core, especially compared to what we see in Korea, what you see in Thailand. So I think you have this element to take into account as well.
You mentioned also you're expecting deflation to be maybe at a peak right now. I mean, they did set that quite ambitious goal of 2% inflation during MPC.
Yeah.
Are those kind of the worst days behind us when it comes to deflation in China, you think?
You have still some deflationary pressure. The housing crisis is not over. But what you see, especially when you look at the upstream price, you see some upward pressure. So that's why if we think in terms of the momentum, well, we are past the peak. So that's also another consideration that we have in the investment thesis on equity.
Your call on India? Do I buy this dip?
That's going to be the story for the second half in our view. So what we see today is a recovery which is being delayed, with the price of oil putting some pressure on the currency and foreign outflow to continue. But you look at the earnings, well, the recovery is here. You look at the relationship with the U.S., there is a trade deal. So some of the blocking point on the equity market, well, they start to be resolved.
You're still overweight on India. So
yes.
In the second half, though, what would you be looking at as opportunities then?
Well, banks is an interesting sector in terms of the valuation, in terms of the growth of credit. Pharmaceutical is also one sector that we are looking at. We continue to be cautious on the IT services, so that will be a kind of a very long-term story, but maybe not for this year.
I guess just as a final question, I know you're mostly, if not purely equities, right? But how are you looking at the impact of the potentially higher rates if inflation does hold up, and when you look at what's happening in the private credit markets, I know that's one pocket of the market, but it's starting to show cracks amidst the growth story. How does that affect your world?
Yes, so, well, in several ways. So if we see, we start to see some repricing of the Fed. When we get some more conviction that the next move is not going to be a down move but an up move, this is where we are going to be more concerned for in the Asia equity space. Private credit is obviously one concern that remain very much into the US at the moment. And the flip side will be how, if it's really becoming big, how it will impact the dollar.
Okay, Frank, it's great to have you. Frank Benzimra there, head of Asia Equity Strategy at Societe Generale. Back to our top stories now. Chinese brokerage Guotai Junan says that one of its employees was detained after Hong Kong authorities raided its office. The raid also targeted Citic Securities' local unit. Let's bring in our Asia Finance and Wealth Managing Editor. More on the scoop with Lulu Chen here. On what are the latest in terms of what details we know at this point?
Well, what we know is that the authorities raided the offices of Guotai Junan and also the local arm of Citic Securities yesterday. At least one senior executive was taken away. They focused on the ECM desks, and also this is against a backdrop where we're seeing the regulators really zooming in on inspections of the quality of general financial markets and also IPO work.
And can we deduce that those could be the reasons behind the move?
Well, we don't know what the exact reasons were for this specific raid and also why this exec was taken away. The SFC, ICAC has so far not commented on the moves. What's happened, some recent developments in the past few months and weeks might provide clues to what is happening against a bigger backdrop. So the regulators have said they've warned banks of sloppy IPO work. And then last week we also reported that they tightened the approvals of so-called License 6 licenses, permits for bankers. This is a key permit for bankers who work at any firms that want to sponsor IPOs. So the scrutiny is on against the backdrop where Hong Kong is seeing a revival of financial markets and also IPO booms. It's a developing story and we'll be tracking it.
Yeah, our BI analyst Shani Wong kind of had a reaction piece too, of course, to Scoop, and saying that this could be a potential red flag for the IPO market. And, given this intensifying regulatory scrutiny amid Hong Kong's IPO boom, poses a risk to major investment banks operating in the city. What do you think other bankers and firms are really looking at now, given this raid? I mean, is this really going to be a big warning for the whole industry?
Well, for any bankers working in this industry, they'll be tracking this case closely. And then also, because you said the warnings that authorities have already given out to bankers about the IPO work, it does put a pause in terms of the amount of work that they'll be taking on. And also, they'll definitely be paying more attention to the quality as well.
Okay. Lulu, thank you so much for unpacking what we know so far. We'll track it, obviously, developing story, as Lulu was just pointing out. There are Asia Finance and Wealth Managing Editor Lulu Chen here. Guotai Junan has said its operations and finances remain normal. Stocks related to this are down quite a bit, as one would expect. Okay, just ahead.
Yeah, we're talking earnings here with GoTo's CEO next. After their forecast for this year topped estimates, fintech was strong. This GoTo demand certainly is on demand, I should say. It certainly was strong as well. We'll get Hans Patuwo joining us next. This is Bloomberg.
Right, welcome back. Just pouring through this earnings report coming through here out of GoTo Group. The numbers are coming up on your screens very, very shortly. We're looking at growth, of course, in terms of revenue, going down to EBITDA, all the way through there. Beating estimates, boosting momentum here for the Indonesian ride-hailing and food delivery company amid, of course, its rivalry with Grab, and that's a separate story, of course, we'll get to in a moment. Joining us now is the CEO, Hans Patuwo, joining us exclusively here from Jakarta. Hans, good morning. Thank you for coming on the show. I hope we can get straight into this, right? So you're looking at you provided some guidance in terms of where you think your profit will be this year. My question to you is, what assumptions are you making on your top line that gets you to that guidance of, I think it's 3.2 trillion rupiah?
Yeah. Well, thank you very much. I'm very glad to be here. As you've mentioned, we have put out our guidance for this year. We have baked in some growth, both on the on-demand side of the business, as well as on the fintech side. But if I may, to just provide a bit of a background, our 2025 adjusted EBITDA is a significant improvement versus 2024. Adjusted EBITDA for 2025 is about 6 times, or about 500% growth over the year prior. And we're seeing pretty good momentum coming into this year. And hence our guidance for this year, we're expecting somewhere between $190 to $200 million of adjusted EBITDA, which represents about a 60% increase versus 2025. The one thing though, I do want to caveat is we are keeping a very close eye on oil prices. And certainly if oil prices remain very high for a sustained period of time, that would have an impact on the economy and potentially impacting demand.
I'm wondering what sort of models or what are you kind of tracking right now on how long, depending on how long this Iran situation unfolds, what do you think the impact could be on your earnings potentially if this situation drags on for months?
I think they're twofold, right? On the one hand, certainly if the oil prices remain high, then core inflation in the country will also increase, and that would reduce the purchasing power, which will affect the ability for kind of our on-demand services business. On the other hand, though, we have 2 cylinders firing, right? Not just the on-demand service business, but we also have now the fintech business. So we have some, shall we say, flexibility in terms of where we focus our attention and where we overweight investment and how we tweak the business moving forward. Even on the on-demand service side, we have a fair amount of our customers who are on the affluent user base. And typically what we see is that the affluent user segment their demand tends to be less elastic. They're more willing and able to pay. So we think that there are some wiggle room, albeit, and this is still something we are keeping a very, very close eye on.
Hans, maybe just one last question on oil before we move on. And you speak of on-demand, and that's a good thing, of course, that the sort of elasticity conditions are not as extreme that you might be able to weather that. But have you modeled, just in case, because it's rare we get oil prices moving so quickly into where they are currently. And I wonder, is that going to be passed on to the consumers? How are you looking at this in terms of scenarios?
Yeah. I think there are 2 ways to look at this. So one of it is if we look at oil prices, some of the oil prices in Indonesia are still relatively subsidized. So we need to see what is the movement of the oil price here on the ground, particularly for our ride-hailing drivers, because you can imagine that they're using more of the two-wheelers. So these tend to be the lower price, more subsidized fuel. So we need to work with the government to try to understand, what is going to be the policy moving forward. On the other hand, in terms of providing relief, I think there will be an element where we may have to think about providing potentially surcharges to our, let's say, our affluent orders, while at the same time seeing what we can do to cut costs elsewhere to help offset the increased cost for our driver partners.
There's one thing that analysts noted, which was your gross transaction volume growth, which was in the single digits of 2%. What do you think that's a symptom of? Is it a sign of just this market is too saturated? Is there any way to actually boost those numbers, you think?
Oh, absolutely. So I think what we're seeing, so if I take a step back, right now, again, we have 2 businesses, the on-demand side, Gojek, as well as the fintech side, GoPay. On the on-demand side, we have been focusing on profitability. So our margins in 2025 have expanded. We ended the year at 2.1% versus 1.1% a year ago. On the GTV side, that has grown 7.5%. And to be honest, I think we aspire for a number higher than that. Now, your question is about transactions. And that flows on down. So what we're seeing is that there are 2 very clear, distinct segments in Indonesia. the affluent consumer segment, and then the mass market consumer segment. And what we're seeing is that for the affluent consumer segment, their GTV is increasing. They're transacting more, their basket sizes are getting bigger. However, where we have homework to do is on the mass market. You can imagine for the mass market, the basket sizes will be lower, and the number of transactions will be fewer per user, but this will be quite a lot of transactions given that vast majority of the population in Indonesia are still mass market. So we have homework to do. We need to grow significantly our transactions in the mass market of these lower basket size orders, and we need to do so not with additional spend or discounting, but rather with building new capabilities that can serve this segment at a lower cost point.
Right. Let's pivot. Maybe Hans, let's talk about fintech. Would you say that specific business is more insulated? How much visibility do you have over growth this year, specifically on that unit?
We are very, very excited about fintech, about its trajectory in the past, and we think it will continue to grow at a rapid clip this year. If I may, right, the story about the fintech story really started several years ago. Going back very briefly, to 2021, where we laid the foundation by really overhauling and re-architecting our back-end systems. And then in 2022, we launched credit scoring ability and lending. We followed that up in 2023 with launching of the standalone payments app, the GoPay app. We started to see all these three come together in 2024, and in 2025, it's just really taking off. We see continued momentum in 2026, and we think it will continue to grow at a fairly rapid clip this year.
Everyone's talking about AI, Hans. I'm just wondering, how are you integrating AI into your technology and into, of course, your platforms here right now? And in terms of cost savings, productivity, can you give us a bit more stats on really what sort of traction you're getting so far?
Yeah, so AI is everywhere all at once. I think three major pillars that we are thinking about it, right? So number one certainly is cost efficiency. Look, we're trying to figure out what is it that we can do whatever we do today more efficiently, more effectively. I think that's par for the course. I think the second area where we are spending a lot of time is building up capabilities specifically around personalization. Right? And the main goal of personalization, what we're aiming for, is to increase conversion rates. And this spans the whole spectrum, right? From having much better AI in our KYC processes, which, as you know, is very critical for our lending business, all the way to personalization of offerings, automatic reconfiguration of the app, and basically having different consumers see different things on their app, and so on and so forth. That's a very, very big effort that we are putting on right now. And then last but not least, we're spending quite a bit of effort on trying to make sure that we use AI and machine learning to further improve our core processes. Two major core processes that underlie the entire business. One of them is our allocations. So we are using machine learning, advanced AI to think about how to take that to the next level. And the second core capability is our credit scoring ability, which of course underlies our lending business and is the profitability driver for our fintech business.
Okay, Hans, apologies, I just need to be thorough here. When does the last financial metric turn positive? I'm talking net income.
So we have a plan, and we hope that it will be very soon. I will not be able to divulge details, but if I think about the whole story, we were to adjusted EBITDA positive a couple of years ago. Now both units have turned adjusted EBITDA positive, and clearly net income is the next goal, and we have a timeline in mind. I'm not able to share it right now, but it won't be too long. That's the aspiration.
Okay, can I just ask, maybe you could divulge some information on this next question. Where are we on the conversation with Grab?
I'm not able to speculate on this point, I'm afraid. I think, look, what I can say is that we obviously are, as a public company in Indonesia, we are regulated by the local authorities, and we had filed. So we have the obligation to inform the local authorities on the capital market authorities about where things are at. We made a filing last December, and I think things have not substantially shifted from there. So I think that would be what I can share on this topic.
Hans, we certainly appreciate your time and being candid, of course, where you can. And let's please do this again. Thank you so much for joining us today. Hans Patuwo, their CEO of GoTo Group in Jakarta for us. A reminder, of course, for our Bloomberg clients and viewers here, our new online feature, that's the Bloomberg Video Hub. Subscribers can explore live streaming news and interviews, all of our TV shows, report analysis, documentaries, and all the breaking news over the last couple of hours, even minutes or so. Check that out, bloomberg.com/videos.
Yep, now to other corporate stories that we're following for you this morning. Financial stocks in the U.S. exposed to private credit slipped as a spat of redemption requests rattled markets. Apollo said it's now ramping up efforts to give its investors more regular insight into the value of its private credit holdings. Meanwhile, Morgan Stanley capped redemptions from one of its private credit funds. That's after it returned about half of the capital that investors sought to cash out. Japanese digital wallet provider PayPay is said to be planning to price its U.S. IPO at $16 per share, below its marketed range. At that price, PayPay would have a market value of about $10.7 billion. Sources say the SoftBank-backed company is poised to price about 55 million ADRs, putting the deal on track to raise $880 million. And sources say Netflix will pay as much as $600 million for Interpositive, the AI movie-making company founded by Ben Affleck. It's one of the largest AI deals by a major Hollywood studio. Bloomberg's been told the actual price paid in cash was less, but its owners will earn more if it meets performance targets. Interpositive develops tools that allow filmmakers to alter existing footage.
Right. Let's have a look at these markets right now. And I think it's probably accurate that most of us are probably like the popular Ben Affleck meme. You know what I'm talking about.
Taking a breather.
Taking a bit of a breather, given just developments where we are right now. Ever-moving story, fast developing. We're looking at weight loss drugs. Lilly, of course, to be investing that amount, of course, in trying to boost their obesity pill and conditions there. Right. Chinese markets are actually doing okay. And they have been an anchor really throughout this storm here. CSI 300 has effectively been trading in a very tight range amid all that volatility out there. This is a state of play, 25 minutes into the cash market session.
Yep, coming up, we have more wrapping up MPC out of Beijing as well. We have Xiaoyan Zhang joining us next. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI a half hour into the session. As we've been talking about, relatively speaking, doing better. There is some sun that's crossing through here in the skyline here this morning as well, where you are seeing almost Chinese markets becoming almost of a haven amidst all this volatility. When you have Brent approaching close to $100 once again, you start to hear more about this is more than just fear now. What the oil markets are looking at, the fear of maybe potential supply losses. It seems like right now the supply losses, it is actually happening. And that this is not just something that's transient or short term, but maybe something more structural too.
It is. And I mean, we first need to get over the fact that it's hard to come by supply. And if you are able to come by supply, you still have to pay a massive premium for that too, right? So it's funny how quickly our perceptions changed when we went from, oil was very recently in the high 60s.
Yeah.
And now we treat a drop to 85 as a good thing. And that's 40% up year to date. So if you think about it, this inflation thing is here and we need to start modeling, let alone 150, right? And some of the forecasts coming through here out of CBA and Bloomberg Economics, that worst case at 108 has been moved back even further to 150, 160. And
that's if things go on for months, right? So CBA says $150 oil is possible. BE says if we get 3 months of closure on the Strait of Hormuz, we get to 160 or even higher. So those we talked about 108 was scary numbers. These are getting scarier into scary territory. That's why you're seeing stocks are on offer here once again. And you take a look at when it comes to how crude markets are doing. Yes, we're at $98 for Brent now, 93 for WTI. Shanghai crude is kind of following up that spike. And really, this is despite the fact that you're hearing from the IEA talking about the most amount of strategic petroleum reserves they've ever released is on its way. That's despite the U.S. also releasing their strategic reserves as well. The market is ignoring it at the moment, Dave.
Yeah, and, a lot of it is also because of the mechanism through which how the global price then gets passed through onto users on the ground, right? So that mechanism takes days, if not weeks, and then once things start to unwind, how long does that sort of part of the oil market start to heal? And that's just to say, of course, what will be the lasting impact of this in the event we do get a quick off-ramp here? And what rips higher is still a key question out there. President Trump, of course, to the point Yvonne just made there, the release of emergency oil reserves by the IEA would ease energy pressures, he says. Well, the U.S. is also working to finish the job, as he says, in its campaign in Iran.
Well, it's only good if you win. You can only do. And we've won. Let me tell you, we've won. You never like to say too early you won. We won. We won the bet. In the first hour, it was over.
Jill Deepens, our news desk managing editor. You're with us here right now. I'm sure your team is just so busy watching all of this. What's the most important thing to watch, you think, when it comes to Iran now?
I mean, look, I think at this point, you can listen to all this rhetoric coming out of Donald Trump, but as we know, markets are now starting to kind of put this to the side, because at the end of the day, the thing that matters to investors, to markets, is the fact that the Strait of Hormuz is still basically closed. And we've still seen some developments overnight, including, some additional, attacks on oil tankers near on Iraqi shores. So, there's still that sort of threat of, that ongoing military action. We still know that a lot of this is still unfolding. There's a lot here that's basically telling the market that, you can listen to Trump say all day that, things, are coming to an end. But at the same time, he also kind of conflicts with himself and with some members of the Trump administration. You've got, sometimes he's like, okay, well, this could go on for, 5 to 6 weeks, 4 to 6 weeks, what have you. Then he also said, there's not necessarily a timeline. So, the market's looking at that and saying, well, it's really difficult to figure out how to interpret this, how unclear everything is. And at the same time, you've got a military strike still going on and that threat to supply that just continues to persist.
Have they, I don't know how to phrase this question, have they spelled out what a win looks like?
At this point, it's still really, really difficult to kind of tell because, you had, before the new Supreme Leader was chosen, the son of the old Supreme Leader, who Donald Trump has also said repeatedly in the past, there was an unacceptable choice. You've got, that idea of regime change that's kind of entered the equation. Obviously, that's kind of, not necessarily resolved, potentially in the way that Trump ultimately wants to see. So it's really kind of difficult to see what exactly that looks like when, again, you do have some of those conflicting messages. I do think at the end of the day, obviously Trump continues to project this kind of confidence over where exactly things are headed. But again, as we've seen, you haven't really seen that kind of, unfold on the ground. I think the other thing that's really worth pointing out is that, at least from the Iranian side, one of the things that they want to see in order to, bring forth a ceasefire is a pledge that even after the war concludes, they're not going to see additional attacks from not just the U.S., but Israel as well. And that seems to be something that they're not entirely confident the U.S. can actually secure if there were to be a ceasefire. So I think that that's another part of this too that just really, really, continues to, hate to belabor the point, but the uncertainty is such a massive part of this right now.
Jill, thank you. Jill Deepens there, our news desk managing editor on all things related to Iran here this morning. You can also check out this piece from our team at Bloomberg Economics, right? So they're modeling out what this could look like if we're talking about not just days or weeks, but months now. Ziad Daoud, chief emerging markets economist, saying, look, 105 is what we could see Brent prices if we see 1 month of closure, 164 if we're talking about 3 months where effectively the Strait of Hormuz is shut.
Yeah, this has really become a regular daily read for me. Fantastic piece and insights going through. And as they sort of update their models, given the ever-evolving situation there, check that out as well. The other thing that we're talking about, and perhaps adding to reasons why this market is adding a further premium going into pricing today, private credit Here we go. The last 24 hours have seen all these headlines coming through in terms of are cracks starting to appear, or are these simply just cracks and we can treat them as idiosyncratic events in and of themselves? Morgan Stanley, Cliffwater capping withdrawals. You have, of course, the latest companies to put in place measures to, I guess, limit the caps on the ATM machines, if you want to take a banking example to that too. Investors are seeking to redeem, of course, more than the vehicles currently allow. Let's get the latest here and wrap things for us and where exactly we are in this story. Our Asia Credit editor, Finbar Flynn, is with us out of Tokyo. Finbar, it's been a busy last, let's call it, not just day or so in the space. We keep seeing these stories come out over private credit. What's going on? Is there a big picture here?
Good morning. Thank you. Yes, I was listening to the start of the segment here, and I can tell you that asset managers here in Asia are saying to me, credit managers, that they're more concerned about private credit than they are about the war in Iran. So they are really concerned. The problem here on private credit is this is a huge industry with about 1.8 trillion in it, but they've taken a segment of this industry which is very illiquid. It's loans to junk-rated companies or lesser-rated companies, and they've put it in a retail-focused sort of fund or funds. And now these are much more skittish type investors. They're wanting some of those funds back. They're clamoring for those funds back. We're seeing, double-digit redemption reclaims in a quarter. So this is a very uncomfortable moment for private credit and for credit markets globally.
Yeah, amidst this sort of investor exodus, I mean, what do we need to look out for next, Finbar?
So I heard you mention some of the headlines, and I think we're going to keep seeing a bunch of these headlines because there's more than 100 billion in these type of retailer-facing funds, and we're going to see continued first quarter announcements which will detail these redemption claims, these withdrawal claims. So that's one thing we have to keep an eye out. The other thing is you saw that very, I suppose, important story last night on JP Morgan, and they have actually restricted some lending to this sector because they are looking at the loans in these books, and some of them are to software, and we know all the headlines about software and AI, and they're restricting lending to some private credit funds as much in their eyes.
Okay, Finbar, lots to talk about here. So I think we've addressed part of the issue, which is it's almost like extreme plane turbulence, right? So we know it happens. We know these can be individual events. The more we look, though, the more we spot them, I think is another way of putting that. How is this affecting broader public credit markets and spreads, if at all?
So it's a great question. I think PIMCO's president, he put it really well in a recent comment. That he said, it's not just the crisis of confidence, it's a crisis of really bad underwriting for parts of this sector. And we are seeing this trickle slowly, not hugely, into public markets. Spreads are wider now. It's harder to disentangle this from Iran and everything, but we're seeing wider spreads in public markets. They're not hugely wider, which is good. I think even PIMCO is not expecting this to result in a larger credit crunch. But oil and private credit and AI, they are tied together. If we head into a recessionary type scenario, it will look very ugly.
Finbar, I mean, how do we look at this in Asia? I mean, I know a lot of these headlines are coming from the U.S., but we've seen banking stocks where you are in Japan really have reacted quite negatively to some of these news that we've seen when it comes to the private credit space. What is the impact to Asia?
So Asia, fortunately, actually in the public markets, we can see that spreads in Asia for the best rated companies are actually still tightening. That's a big difference from the United States. Asia is still a very much banked type of market, and the exposure to private credit in this part of the world is less. But we also hear, even in Japan, we have these private credit funds from people like Blackstone that are actually sold to retail investors here in Japan as well. So we have to keep an eye on that. We have to keep an eye on how redemptions from this part of the world are going to bubble up.
Finbar, it's great to have you. Finbar Flynn there, joining us out of Tokyo. Coming up, we're talking about NPC and wrapping things up there in Beijing. Tsinghua University's Xiaoyan Zhang will be with us to recap the highlights from the 2 sessions and what we could be seeing here today, and assess really the impact of the Iran war on China. That's next. This is Bloomberg.
Okay, lots to get into here. Okay, well, that was Yvonne, and I'm David.
I almost wanted to mouth them while you were reading the script.
We should try that one time, actually. We should try that one time.
Let's talk about NBC, though.
Yes,
wrapping up in Beijing later on today. For some of the key highlights, let's bring in our China correspondent, Min Min Lo. She joins us out of Beijing. Min Min.
Hey, David and Yvonne. Today, of course, marks the closing session of the NPC, but it's expected to be a highly choreographed event, so the parliament will likely pass that 5-year plan, and as well as the government will report without any major challenges. But of course, today also is the day when we have Jamieson Greer, the U.S. trade representative, announcing that his office will be launching probes into over a dozen countries under Section 301 of the Trade Act, which focuses on overcapacity. And of course, timing is terribly inconvenient, coming just a couple of weeks before President Trump is expected to come to China to meet with President Xi, and certainly this will push the trade and tariff agenda back to the top of the agenda here. So joining us here to dive deep into that, let's bring in our guest, Xiaoyan Zhang, Associate Dean of PBC School of Finance at Tsinghua University. Prof. Zhang, thanks for joining us. I just wanted to get what is your reaction to the news we got from the U.S. this morning? How do you think China would respond to that?
Well, thank you, Miming. It's a great honor to be here. This news came as a surprise to me. I just got to know it. But my rational expectation is, both countries will fight for the best of their nations, and they have been experienced in terms of, back and forth negotiations. I hope something good coming out of it.
What do you think is the baseline and the best case scenario that China would walk away from when Trump and Xi meets?
World peace, right? And international trade not affected. During this very special period of time, we're going through a lot of turbulence in global political environment as well as the global market. So I think the investment community, everybody is hoping for world peace. And, but of course, both countries will fight for the best for their people.
Renewal of that tariff battle definitely puts China's growth priority in focus, and its push to rebalance the economy towards consumption. Based on what we have heard from the 2 sessions so far, do you think it's bold enough to truly have people feel that tangible impact, that their incomes are increasing, that they can be willing to go out and spend more?
Let me put this into a little bit of perspective. From the 2 sessions, I think there are 2 things going on in terms of growth. Number one is there is a national target of annual growth of 4.5 to 5%, which is set in a reasonable, pragmatic range. Now, to get there, it's not easy. Given the enormous size of Chinese economy, to get there, the approach is to upgrade consumption. Now, as you mentioned, Miming, there is difficulty. People are worried about, people don't have enough income or they are reluctant to consume. What I can tell you is the government is committed, okay? We have a bill toolbox, a big toolbox of policy interventions, including fiscal subsidies, including monetary policies. And we're also increasing the minimum wage and minimum pension for a large population of China. So if you ask me, I'm positive and confident, and I know everybody is committed to it. It's not easy, though.
Yeah, it's certainly not easy, and I'm curious because we have seen China miss the inflation target over the past number of years. The focus has been very much on hitting the economic growth target. To what extent should we take seriously the government's intention to hit that 2% inflation target this year?
I would take it very, very seriously. You know, the purpose of the 2 sessions is, we have all the leaders, all the departments sitting together to have a consensus where the country needs to be, right? And it is also broadcast to the whole public. That is what government is committed to do. So far, I have to say, I'm relatively pretty confident in the goals that the government has set so far. They are very persistent and consistent with their targets.
We also got the export and trade data earlier this week, and I was honestly very surprised by it.
Yeah.
Do you think that is like a short-term blip, or is this going to set the pace for trade in the future? And at the same time, this sort of bolsters Trump's argument that China is over-relying on exports. Do you think that's fair?
I'm very glad you raised this question, because when I look at the media coverage and the work reports from the 2 sessions, I have to mention that now we are achieving a balance of imports and exports. Let's start from exports. We have been doing very well, right, for many years. And we have a lot of, services, products, exports. So it's not, I wouldn't think that's a short-term blip. We're doing pretty well. But then on the other hand, 2 sessions this time emphasize we want to increase imports. Why increase imports? Because we want to reach a balance. Now, if we want to relate to the previous topic we mentioned about consumption, if we have a high quality consumption, upgrade the consumption, we need imports. And this is also another way to get China involved in the global chain and or the global trade. So this time we're doing fine with exports. We are also putting more emphasis on increasing imports.
But right now, given what we are seeing in the Middle East and the Iran war, bringing a lot of volatility and energy prices, what steps will China take to protect against those energy volatility, but also the disruption in trade flows as well?
Very good. This is what everybody cared about for the past 10 days. Let's look at this from a broader point of view. You can see for the global market, the stock go down, right? And the volatility increase, commodity is increasing, and dollar is challenged. Now, if you look at the neighboring countries like South Korea, if you look at South to Southeast Asia, we're going through negative news, right? A lot of stock market index went down a lot. Now, if you look at China, let's see, you ask about commodity price, but let's look at broadly the overall capital market reaction to the shocks, negative shocks. And we have to agree it's a negative shock. The market went down, but then it recovered. Volatility has been stable. So China is a place that offers some stability, decreased volatility at this point of time. In terms of commodity price, we saw price went up and down and up. A lot of volatility. It doesn't matter whether it's crude oil or gold or silver or other things. When there is tension in geopolitical environment, commodity price will increase. Now, China is connected to the global market. We will have those shocks, negative shocks. But I think we, with our long-term planning of industrial policy and with our reserve on hand, you ask me, how are we going to do it? First, we're going to stay confident. And we have very strong confidence in our government. Yeah. And so far, I don't see any signs of slowing down in the progress. I also see, some commodity prices going up in China, some commodity-related company stock going up, but I don't think it's going to be crazy.
All right, so Chinese markets certainly proving more resilient than some of the other regional markets here. Thank you so much. That was Professor Xiaoyan Zhang, the Associate Dean of PBC School of Finance at Tsinghua University. David?
Yeah, Meimin, great stuff. Thank you so much. Yeah, we were just bantering earlier on that the A-share market has acted like a time deposit, which is really valuable given everything that's taking place around. Speaking of, we have some news coming through as well, and this is fairly consequential because this is really one of the few remaining ports, we believe, in operation. Oman is said to be evacuating ships from an oil terminal that sits, by the way, outside the Strait of Hormuz as a precautionary move here. It's one of the few remaining ports from which Middle East crude can be shipped to global markets, of course, and that is a fairly important point that we're making here.
Yeah, according to our sources, someone who directly received a notice from the port agent himself, it says that Iranian attacks in the region have made the waters nearby unsafe. If you're talking about the importance of this sort of port, around 1 million barrels a day of Omani oil are exported from Mina Al Fahal. So, according to some data intelligence firms, so certainly the impact of this could be quite huge as well. It just adds on to more of the supply disruptions we've been tracking around the Middle East here right now. Oil markets continue to stay quite elevated. We're talking still about $98 for Brent. We'll have plenty more coming up when it comes to the situation. Still very fluid. This is Bloomberg. We continue to follow this breaking news when it comes to Oman. According to our sources there, that they have evacuated all vessels from its key oil export terminal. We're talking about Mina Al Fahal as a precautionary measure here. So this is what, according to someone that directly spoke to or got a notice from the port agent here, that Iran attacks in the region have made the waters nearby unsafe. We're talking about 1 million barrels a day potentially there that could be impacted from Omani oil that is exported from this key port. So certainly that could be even more market moving in some ways as well. Perhaps that's why, Dave, you're starting to see the likes of CBAs, of Vectar saying what, $120 to $150 oil is possible, given the fact that energy markets still now are underestimating some of the supply risks out there.
Yeah, and this one specifically it's outside the Strait of Hormuz, and it's one of the few remaining ports through which Middle Eastern oil can be then shipped globally, right? So if you're getting more of these switches starting to come offline, then the markets will tend to react. It's also worth pointing out that when you look at Brent prices, markets have not yet reacted. Not to say that they will, but we're not really seeing a reaction in Brent markets as we speak. Plenty more ahead. This is Bloomberg.
All right, continue to track when it comes to oil prices here this morning and bring you the latest when it comes to Oman. So our sources saying that they will be evacuating ships from the Mina Al Fahal oil terminal here after these Iranian attacks have made those waters unsafe. This is still according to sources here right now, but certainly we are seeing when it comes to oil markets, they still remain elevated, as we talked about. Not seeing a huge reaction from that story itself, but certainly this is also a telling signal here of just the supply disruptions that we are still dealing with today. Now, the port agent notice, according to our sources, was that the Oman evacuation at this point is a precautionary measure. But you also are talking not just Oman, but Iraq, too, earlier this morning. They also talked about their oil ports are completely not operating right now. So the supply disruptions continue. That's why you're seeing Brent now hovering around near that $100 mark once again here. That's why Shanghai crude continues to be up double digits here this morning. And this is despite what we've been hearing, right? When it comes to what the IEA said, they're set to release, a record amount of strategic petroleum reserves. You had the U.S. chime in a few hours ago about how they're going to be contributing as well on their release. But we did hear from Jeff Curry, Carlyle Energy Pathways Chief Strategy Officer, and he believes that no policy response can actually stop the rise in crude. He also warns the damage from the war could take months to unwind.
You've disrupted global supply chains. This is not just a disruption oil. It's gas, it's fertilizers, it's metals, it's petrochemicals, the list goes on. And then you've disrupted supply chains in countries all over the world. The ships are in the wrong places. The insurances are being canceled. You've taken the pressure out of the fields that you shut in places like Saudi Arabia or Iraq or even in the UAE. The list goes on. The damage is going to take months to unwind. But I want to bring it to the immediate. there is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. You know, the maximum sustainable flow rate is 2 million barrels per day. So 400, that'll take them 200 days to get that out. And you put that in the context of a disruption of, let's net it out of, it's got to be somewhere around 18 million barrels per day right now. You're just minuscule in terms of offsetting it. So again, there's not many options here.
What would you call this then? A PR campaign?
In terms of doing this, it's all they have. They're going to do whatever they can. But I think the key issue here, keep the hoarding down. Because we know what happened in the 1970s when you got the hoarding. It created an increase of demand of somewhere around 2 million barrels per day. In the size of this market, try 3 million barrels per day.
Yeah, there we go. Jeff Curry there with our team at Bloomberg Surveillance there, John Farrow and the team there with a fantastic interview on really just context. And this is an ever fluid story that we're talking about. More in the breaking news, of course, earlier on in Oman, which I'm looking at Brent, not really reacting so far, but this seems fairly consequential. And obviously we're keeping on top of the breaking news story here.
Yeah, this is, as what I think Ian said, a pretty interesting note about, there used to be a distinction across these markets. At first, I think people were trading on fear. And now the supply concerns, they say, that distinction no longer holds up, that you're starting to see structural risks here. It's not just a short-term sort of blip when it comes to these potential disruptions. And that's why you are seeing the likes of...
99 now.
Oh, there you go. $99 when it comes to Brent. That's why you're starting to see the likes of Bloomberg Economics saying, $160 oil in 3 months if that Strait of Hormuz continues to be shut for that long. You also start talking to corporate execs about what the business impact this could really have. And I think it was quite telling to have the GoTo CEO Hans Patuwo just a couple of minutes ago on the back of their earnings, right? And they said, look, we're watching oil prices very closely. They of course do ride-hailing,
motorcycle,
food delivery, and the like. And said, we might have to start adding these oil surcharges to some of their clients and customers.
Yeah, that's really where literally the rubber meets the road on the story, right? EM economies that are getting punished because of this, the fuel at the pump. In the Philippines, for example, gas prices are on the way up. Indonesia, these are not, very the elasticity to the sensitivity to oil prices.
You hear about stories of people lining up at gas stations in Southeast Asia, right?
Yeah.
You're starting to see images that really pop up around the world.
Yeah. Okay, you know what? Can we keep on top of the oil story right now? Because I'm looking at Brent prices right now. We are now at session highs on Brent at 99.73, so we're about 25 cents short now on the most active contract of taking out the 100 level. This is something that we're obviously going to be following closely. Equity markets are not going to like this. India, which has been really pummeled of late, will probably take this on the chin when that market opens up later on. The rest of the region, can we get an MSCI Asia Pacific up, please, if we can, intraday if we can as well, and look at these markets. So Brent opened at north of 99. We did dip back below towards the 97 handle, but as you can see and as we speak now, we are inching ever closer. There we go, $100 on Brent crude coming up on your screens on the back perhaps of this news coming through here.
All right, here you go. We basically approached back to those levels since we saw basically on Monday, right? So it's been 4 days of volatility, and here we go, right? We continue to watch what happens, and I think it is what the most important thing, as everyone we talk to about, is really the state of play at the Strait of Hormuz. But yes, this Omani port certainly is very, very the next headline here that people are contending with. When you talk about this is one of the few remaining ports that is actually still being able to move Middle Eastern crude and shipping it around to global markets. If that also is now effectively shut, in the short term, you're talking about, according to some data firms, 1 million barrels a day of Omani oil that is potentially now impacted that used to be exported from this port. So that certainly is one thing to watch. The risk-off session across markets, it's been relatively tame, I have to say. I'm not sure now that we've reached 100 once again what investors are thinking about right now, because it's interesting, too, leading up to this. I was reading this note from UBS that was talking about Taiwan Taiwan specifically, right? That, the correlation from stocks to oil prices have actually fallen in some markets like Taiwan. And so maybe the bigger catalyst is maybe the supply chain and AI, NVIDIA, there's a big event coming up as well. I think when you mentioned about a market like India, I think it's a different story because they don't have that sort of AI supply chain sort of, I guess.
It's not part of the index.
Yes.
Yeah.
So I think, as Frank Benzimra from SocGen said, when it came to India, they're overweight, but it could be a second half story given that it is a delayed recovery now because of the price of crude.
Yeah, he acknowledged that as well. So you have two markets in the Asia Pacific that they're overweight. It's China and India. And he says India, of course, is, despite the rating, we're going to have to wait for that to really come online. I should also mention Thailand has also been hit quite badly. That market also opens up later on as well. So we're watching all this very, very closely. Sensitivity to oil prices. If you're an oil importer, if your currency's taking it, that's effectively the current account deficit showing up in energy markets right now and in the currency markets. We're looking at India futures. Guys, can we get that up, please, as well? I'm curious what they're doing right now. MSCI Asia Pacific, last we checked, we're falling on the benchmark itself. Give me a moment here while I just verify.
You're starting to see
ahead.
Hong Kong now joining in on this kind of risk-off moves here. We are now deepening the sell-off here. Hang Seng now seeing losses of more than 1%. Asia Pacific is now lower by 1.6%. I might have spoke too soon on this whole Taiwan story. When you take a look at the TAIEX and what's going on there right now, we're lower by 1.6%. This is still, risk sentiment is still very, very headline-driven right now.
It is. So to anyone perhaps that said we might be past the hump, I think the price action and sensitivity we're seeing across these markets right now perhaps is evidence to the opposite of that. Asia Pacific now, I can tell you, is at session lows at 1.5%. Let's bring in Lian Ting Tu, our managing editor for Asia Equities, joining us out of Singapore as we try and unpack and follow this breaking news story. Lian Ting, take us through what's going on in your team and how we're now looking to cover this equity market sell-off that seems to be gaining traction as we speak.
Yeah, I think today very much the biggest story is the oil market, right? As you guys were talking about, the new risk is emerging right now with the reports on how two tankers in Iraqi waters were being attacked and also Oman evacuating ships out of oil terminal. So that is something that people haven't really factored in before. And that signals to investors that risks to shipping is not just contained in the Strait of Hormuz. It's actually much more widespread. And then you're now seeing, people are factoring that into stock prices just because also Asia is the most vulnerable to the shutdown of the Strait of Hormuz and higher oil prices. So MXAP hitting session low just now and Hong Kong also reflecting that kind of risks. And if you look at that kind of drop versus the US futures are actually a lot more muted. So yeah, that just basically showing that people are just a lot more sensitive to that kind of risks in Asia and when it comes to Asia equities.
Yeah, I mean, it seems like it is that oil price that is dictating almost everything at this moment when it comes to the equity space. I mean, but you add that to some of the headlines when it comes to private credit. Even the OpenClaw sort of trade in China is unwinding given some of the regulatory scrutiny. You have, brokerages in China being raided. I mean, it seems like there's just more bad news, really. The headline risk is more than just Iran, too, here in the Asia Pacific.
Yeah, I think right now people are really thinking about protecting their portfolios, right? What kind of hedges they can put on. We've been asking people what are they doing, to protecting their portfolios. People are talking about, of course, using put options. And we saw after the record sell-off in Korea last Wednesday, that we see a record amount of put buying by retail investors in Korea. So that activity is full on. And also elsewhere in the equities market, we're hearing people talking about being more defensive, buying high dividend stocks, as at least they provide some kind of income cushion, and also the sector that is more exposed to domestic demand is being touted because they're less exposed to macro risks globally. And of course, holding liquidity is a very key thing that people are talking about. So cash is really the king right now.
Yeah, Lian Ting, thank you so much. Lian Ting, to our managing editor for Asia Equities in Singapore. I think cash is king to the point Lian Ting was making. The dollar is stronger, And in case you missed that statistic, right, the record amount of money that is being parked and is parked in money market funds, we'll try and effort that for you a bit later on. But yes, equity markets are selling off. We spoke too soon. U.S. futures are now down 1% on the back of this 10% surge in Brent prices. Now, just to also reiterate, in case you missed a breaking news story, the reporting out of Bloomberg is that ships are being asked to steer clear of that port as a precautionary measure. It is a port, one of the few remaining ones outside the Strait of Hormuz that does remain operational. We haven't heard just yet from the port itself. The news flow, though, suggests that markets are reacting first and asking questions later.
Yep, and I think the knee-jerk reaction is buy the dollar, sell stocks, and bring up the price of oil to now $100 for Brent. So certainly that is going to be the fear that we're seeing when it comes to risk sentiment here today. And that's despite, of course, the IEA with that a big announcement about that oil reserves release. So we're continuing to watch EMFX, for example, now getting hit and slammed quite hard here in the region this morning. We'll have plenty more and check on these markets coming up. This is Bloomberg. All right, in case you missed it, we're back to $100 oil when it comes to Brent here this morning. This is on the back of our sources telling us that this key Omani port they've been urging vessels to basically avoid this port here right now. So the supply disruptions continue, and you are starting to see, the risks to that and what's happening in the Strait of Hormuz are much larger than even what the IEA can handle when it comes to releasing these strategic reserves. And you're seeing that be reflected across risk assets here. So with $100 Brent, obviously we're talking about stocks are sold, dollar is catching a massive bid, and we're watching bonds continue to be in a rout here right now.
Yeah, I'm looking across my global macro movers here on the Bloomberg terminals. As Yvonne is pointing out, equities are down, recession lows there. The currency markets and the yen is actually how it's being express as it pertains to if you're an oil importer and that's your currency, you're probably seeing your currency come under pressure. We are back to $100 on the most actively traded contract here on Brent. So we opened just above 99. We gave back most of those early gains, but as you can see now, the headline is up about 10% currently on Brent crude. Bond markets, Aussie 10-year yield, 10 basis points to the upside, the short end as well, as the bond markets are also feeling the pinch. I think if our map is ready on the Bloomberg terminal, you can actually find the specific port. What we've done is we've just placed it as a placeholder, and just to give you a sense of the relative area, the top part, that's the Strait of Hormuz, where things, of course, narrow. The port specifically in question, and our reporting, to be clear, suggests that ships are being asked to stay clear of that port. Rightmost side, that very tiny yellow circle where Muscat is in Oman, is where this specific facility is in place. We have yet to hear, by the way, from the port itself. But yeah, you have more context in terms of what this port means in the region and how much output we have here, too.
We're going to get some more context from the scoop about what sparked this evacuation order. This is after drones struck fuel tanks at Oman's Salalah port on Wednesday, while others were intercepted. This is according to the state-run Oman News Agency, which cited a security source. Salalah, meanwhile, has since suspended operations at its container and general cargo terminals, while other Omani ports are working normally. So this is why we're seeing some of these evacuations are getting a bit more, spreading a little bit more. But this just goes to show how the crisis that we're seeing when it comes to the Middle East is deepening and now threatening oil shipments from terminals outside of the Hormuz Strait as well. So it's not just the Hormuz waterway itself, but even what's around and surrounding it, right? So when you take about loadings from Fujairah in the UAE and also outside the strait are continuing, but some ship owners are also avoiding the port now due to the risk of attacks. So certainly there is that disruptions. The Saudis, meanwhile, is still sending oil through this pipeline to Bunyan on its Red Sea coast. So there's still that's going on, but we're still talking about 1 million barrels a day of Omani oil that is exported from this Mina Al Falal port. So certainly the impact is big. You talk about the supply risk, of course, and really disruptions there. And then now you have to start to deal with not just the physical shortfalls, according to CBA, Dave, but also the demand destruction that could unfold too.
Yeah, 150. That was the forecast coming through from Vivek Dar at his team there at CBA. They're putting their latest projection, worst case projection, I believe, about 90 minutes back. If the conflict is not resolved, we're looking at a risk of rising to levels not seen in history. We're not trying to scare anyone here. That is, of course, I'm just reading his note verbatim here. Prices could then rise even further if advanced economies need to set the price for demand destruction. In other words, you get to a point on the demand curve on oil where it becomes counterproductive for both buyers and producers of oil because it simply prices out most people that can't afford it. It becomes a political issue. We've talked at length about this earlier in the week when we did cross above 110. Not to say we're close to that at this point, but we started out. It was this time yesterday when we were trading in the low 80s, I believe, and here we are yet again with 3 digits on Brent.
And brings us back to around this time on Monday, right? When this all first unfolded and we woke up to $100 oil. We are now back to that possibility. And maybe not just the potential and what this means for inflation expectations. That certainly is one thing to watch. Also, the potential hit to growth as well if we continue to deal with high gas prices for a prolonged period. And so that certainly is what the market is pricing in here at the moment. We'll continue to watch what happens with these disruptions as things look right now in the Middle East. And as the Middle East markets, of course, open up and wake up to this reality and what we're seeing in Asia. So what else are you watching, Dave? I mean, it seems like as Lanting mentioned, equity traders at least now are putting up hedges everywhere.
Headline risk, right?
Yeah.
So it's not happening today. It happened yesterday. Something strange happened in the Japanese markets. The cash market was up. The Nikkei Vol Index was up. Normally, you don't see those two things move in tandem like that, but it just underscores, I guess, the hedging that's taking place here in the region. Okay, it's worth pointing out that we are coming off highs ever so slightly on Brent. Dollar yen is now back above 159. That's not the high of the session so far. The high of the session was 159.24 very early on in the Tokyo session. What is now at session lows is the MSCI Asia Pacific. We're now down 1.6%, I guess, as we continue to digest the news and the extent to which, and it's certainly not, it's a net negative. We're trying to figure out, of course, markets are trying to sort of triangulate the extent to which this is a negative. But the fact that you are getting precautionary and understandably precautionary measures for facilities there in the Middle East, talking about how they're taking things offline, given everything that's happening within the vicinity, is obviously bad news as it pertains to the oil supply market. And really, if you think about the amount of oil that is being released from strategic reserves and how quickly that is actually able to get to the buyers where they're needed, you understand why the price dynamics are across the Brent curve is the short end is really leading the price gains we're seeing across oil prices, which I guess underscores to some extent some relief further out into the futures curve. But yes, we are very sensitive to headline risk as we speak here.
So we're watching what happens in the Middle East. You're also hearing the rhetoric from President Trump, which I think the market is now kind of ignoring, right? When he's talking about the U.S. is looking to finish the job in this Iran campaign. Meanwhile, you're hearing from Iran, according to our sources, that if there is, in fact, some sort of ceasefire, the U.S. must guarantee neither the U.S., nor Israel will strike in the country in the future. So it's not just a U.S. story. It's also what the Israel and really what their circumstance and perspective is on all this as well. But when it comes to the Iran side of things, we have not seen them in any way try any let up in sight when it comes to their sort of attack. So certainly, there is both sides seem very far apart in any sort of ceasefire at this moment, just based on what we're seeing across the headlines.
Yeah, I think Jill Desus, who joined us earlier on, had really good context here, right? Because it's unclear to many people still what a win will look like and how do we know if the U.S. has won? We know in terms of military supremacy that is on that side, but how do we know with any conclusion that they have won? The other thing that Jill pointed out, which I think is equally, if not more important, even if the U.S. and Iran somehow manage to head back to the negotiating table over the short term, the question Iran would then ask, according to Jill, is that what guarantees can the U.S. give that Israel will also align itself along those lines. So we have a lot of moving parts here to get into. John Herskovitz is with us right now to take us to the latest here. John, what do we know about what's going on? A lot of breaking news suddenly here across the markets.
Some worries in Oman where that involves the closure of the port. This follows what happened with attacks on 2 vessels in Iraq's oil processing port, and this has driven Brent crude up above 100. So the $100 a barrel. So the relief that came from the release of these strategic petroleum reserves, the coordinated release, has quickly been offset with developments in the region, attacks on ports, closures, and this has just added to concerns of what's going on with oil, and oil prices are going up.
And John, it's interesting too that what's telling about this Oman situation is that it's not just what we're seeing in terms of disruptions in the Strait of Hormuz. We also have to track what's going on outside of this key waterway as well, when, this is where a large portion of a lot of these Middle Eastern countries are shipping or at least exporting that crude too. So it seems like things are getting worse and not better.
Exactly. You're exactly right. I mean, what we see going on in Oman and Iraq show that this is beyond the Strait of Hormuz, that other ports are also at risk, that this is region-wide, and it looks like it's going to have a profound effect on the shipment of oil to places around the world. I'm in Japan now, a key importer of oil, especially oil that transports through the Strait of Hormuz. There are concerns about this in markets in Asia, around the world. And the worries about what was going on in Hormuz are spreading. And we had a Bloomberg Economics that did a modeling of what may happen if there's a 1-month closure or a 3-month closure of Hormuz, and it means prices above 100 and perhaps approaching $130, $140 or more if the closure of Hormuz is prolonged.
Yeah, I think it's 160 and change, 168, I believe, from Ziad's team. John, thank you so much. We scrambled you to camera. Thank you. We appreciate it. On this breaking news, Brent is now back above $100, 166 right now on Brent. India comes online in the next hour, and I imagine that market will take it on the chin, given everything that's taken place. That's it from us here on The China Show. We'll see you all tomorrow. Lots more coverage on the breaking news coming through on Bloomberg Television. Keep it here.